Well, we're a couple of minutes past 5 p.m. and the SGX looks set for a slight Friday loss. The Straits Times Index is down by about 0.1% and may be on track to close below 3,200 today, sharing the cautious sentiment across regional stocks after U.S. President Donald Trump announced that he won't be meeting with Chinese President Xi Jinping before March 1, when the temporary truce for the trade war ends. The forex space, though, this week was a bit mixed, and despite the recent dovish stance from the U.S. Federal Reserve, the dollar index actually strengthened a couple of days against some of its regional peers. Take, for instance, the euro today, which is slightly lower against the dollar at about 1.13 against the U.S. dollars for 1 euro, and the British pound also weakening a touch against the greenback, with one British pound now worth about $1.29. Even the Singapore dollar weakened in the last 5 days, despite the protracted trading session for the Lunar New Year. So what have we learned amidst this shortened trading week? Well, we're joined now by FXTM's analyst Lukman Otunuga, who's on the phone with us live from London to help us break down what we've learned. Lukman, good morning and happy Friday.
Good morning and happy Friday to you.
All right, Lukman, let's talk about a lot of the things. A lot of major Asian markets were closed for the Lunar Year for most of this week also. And despite that, though, we've seen some very interesting moves, especially from the U.S. dollar, which took on sudden recent strength a week after the Fed's increasingly dovish stance. Why do you think the greenback actually took on a bit of strength this week? Was it just a matter of it technically bottoming out, or is there something more fundamental behind the greenback's sudden slight flexing of its muscles?
Yeah, it's been a very interesting week for the dollar, and surprisingly, we've seen the dollar remain king of the currency markets, despite the dovish U-turn that we saw last week with the Federal Reserve. When we look at the dollar, I think probably one of the major reasons why the dollar is performing better compared to other currencies is the fact that it still has a competitive advantage. If you look at major central banks, the European Central Bank is cautious, the Bank of England is cautious, the Bank of Japan continues to maintain a cautious stance. The Reserve Bank of Australia as well is also cautious. So it's a situation where all currencies are doing bad. It's just that the dollar is faring better. This is why we're seeing the dollar remaining king.
So it's more of like the misery of or the cautiousness or the skepticism for other major central banks may have been benefiting the greenback. Let's talk about one of those central banks, Lukman, and that's the Bank of England, which made a recent decision. They did keep rates unchanged generally there. What were some of your key takeaways from the Bank of England's recent decision and their outlook for the British economy, and especially how it might impact traders of the British pound?
Yes, the Bank of England is clearly cautious and dovish. One of the key takeaways was how they said the fog of Brexit and its unfavorable impacts on the economy. So we've seen that the central bank has actually acknowledged that the Brexit remains a major risk to the United Kingdom, and the uncertainty it presents is actually impacting business investments, consumer spending, which ultimately would feed to GDP growth. As we can see, GDP was actually cut to 1.2% this year compared to the 1.7% projected in November. So the key takeaway for traders is a rate hike this year seems quite unlikely, and the fact that the Bank of England is not expected to raise rates is going to result in downside pressure for the sterling. However, though, even though this gloominess from the Bank of England has weakened the pound, I think we should keep in mind that with the Brexit still a major theme, Brexit developments will continue to overshadow macro fundamentals.
No, we're still speaking to Lukman Otunuga, who's an analyst over at FXTM. And Lukman, I want to shift our attention now to the Southern Hemisphere and the Reserve Bank of Australia indicating that rates in Australia could go either direction, which some traders are interpreting might signal a possible rate cut there. But do they still have room to cut rates? And what might this mean for the Australian dollar long term, given the RBA's recent outlook?
Firstly, it's been a terribly bearish trading week for the Australian dollar. It collapsed like a house of cards when the RBA actually indicated that a rate cut could be on the cards. Well, when we look at the Australian economy, there's many things we have to keep in mind. Number one, there's tumbling house prices, inflation levels remain tepid, growth is anemic, there's weaker consumption, slower wage growth. So the RBA is actually in a very tricky position, and it's not only domestic risks that are impacting Australia, we also have external risks. We know that China is also experiencing economic deceleration, and Australia is China's biggest China is Australia's biggest trading partner. So as we know, if China sneezes, of course Australia will catch a cold, and this is what's happening with the Australian dollar. It's too early to consider if a rate cut could be on the cards, but for us to come to this conclusion, it will have to be to see if we have a situation where domestic and external conditions continue to deteriorate.
All right, and finally, Lukman, we want to ask you about your outlook for the Singapore dollar. It's been, despite the fact that markets here were closed for about 2 days in observance of the Lunar New Year, we saw the Singapore dollar also take on some weakness against the greenback. What is the outlook? In fact, some analysts that we've been tracking on the Bloomberg terminal, for instance, have indicated that there might even be a bit of a death cross forming for the USD SGD pair. Can you talk to us about what you're seeing in the charts and how this is might impact the outlook for the Singapore dollar down the road?
Yeah, so when we look at the Singapore dollar, this week it's been mostly influenced by the dollar. You know, a strengthening dollar has actually pushed the US Singapore dollar up on the charts. When we look at the fundamentals in Singapore, we know that economic growth for Q4, the flash estimates was around 2.24%, and we also know that the SIBOR has correlated with US rates. So the fact that the Fed is still expected to take a pause on raising rates in 2019 will reflect in Singapore, and this should also mirror in the SIBOR. Moving forward, though, I think the Singapore dollar's trajectory will continue to be heavily influenced by not only the Federal Reserve and dollar's performance, but also global VIX sentiment. If you want to look at a technical picture, though, the technical picture, especially in the daily, the dollar Singapore dollar is looking bearish, and I can see resistance around 1360. There's a wide range, though. It will be interesting to see if prices are able to break below the 13450 in the coming weeks.
All right, that's the outlook for the Singapore dollar from FXTM. Lukman Otunuga over in London. Thanks for joining us this afternoon, helping us dissect what we've learned in the forex markets over the course of the last couple of trading days. Appreciate the time.